legislation consists of compliance obligations for attorneys at law. What is compliance and AML? Financial institutions and the NFPPs must comply with the FTRA 2018, the ATA 2018, POCA, and its implemented regulations. The purpose of the AML safety rules is to help detect and report suspicious activities, including predicate offenses, money laundering, terrorist financing, and to prevent manipulation of the financial sector. Who is responsible for AML safety compliance policies? The compliance officer may be an employee who has other duties in a law firm, but it should be someone in a responsible position. The CEO is responsible for the business's day-to-day compliance with AML laws and regulations, and for ensuring that the compliance program is updated as needed. However, compliance and its culture ultimately lies with the board of directors and senior management. These are the areas that my topic will cover: conducting of a risk assessment, customer due diligence, record keeping, internal controls, suspicious transactions, AML CFP staff training. Conducting of a risk assessment. Every law firm should take appropriate measures to identify, assess, and understand its identified risk in relation to the facility holder and countries of jurisdiction of their origin, countries or jurisdiction of its operations, and its products, services, transactions, and delivery channels. Develop and implement a comprehensive risk management system approved by senior management. Take appropriate measures to manage and mitigate those risks. Take account of any risk assessment carried out at a national level and any regulatory guidance issued by its supervisory authority. And upon request, provide the supervisory authority with a copy of its risk assessment. Conducting of a risk assessment. A risk assessment should be carried out prior to the launch of a new product or business practice, prior to the use of new or developing technologies. The assessment is to identify and assess identified risks that may arise in relation to such products, business practices, or technology for both new and pre-existing products. Such assessment shall take into account the facility holder's geographic area, product, service, transaction, and means of risk delivery factors. Customer due diligence. Law firms should undertake customer due diligence measures when opening an account for or otherwise establishing a business relationship with a facility holder where doubt exists about veracity or adequacy or previously obtained identification information of a facility holder. There is a suspicion of activities relating to identified risk involving the facility holder or the facility holder's account. A person who is neither a facility holder nor an established business relationship with the law firm wishes to carry out a transaction referred to as an occasional transaction. It is determined that an occasional transaction is being conducted on behalf of another person. Sections 7 through 9, 13, and 14 of the FTRA shall apply. Ensure that these requirements are met with respect to facility holders and beneficial owners with which the law firm has a business relationship, and such measures shall be applied at appropriate times and on the basis of materiality and risk. Depending on the type and nature of the facility holder, the business relationship, products, or transactions. A law firm shall not establish or maintain an anonymous account or an account in a fictitious name unless there is a suspicion of identified risk, in which case the full range of CDD measures must be applied without regard to any monetary threshold. In fulfilling the obligations imposed by Section 1, by subsection 1 of Section 6 of the FTRA, all law firms shall identify the identity of the facility holder by means of verifying reliable independent source document data, or information. Identify and verify the identity of any person purporting to act on behalf of the facility holder, and verify that such person is properly authorized to act in that capacity. Understand and, as appropriate, obtain information on the purpose and intent, nature of the business relationship, including the ownership and control structure of the facility holder. In addition to the above, every law firm shall identify and verify the beneficial owner of the facility. When applying customer due diligence measures, the law firm shall take into account the outcome of the risk assessment required to be conducted pursuant to Section 5 of the FPRA with respect to each facility holder and business relationship. Where the risks identified are low, the law firm shall conduct simplified due diligence measures unless there is a suspicion of activities related to any identified risk, in which case enhanced customer due diligence measures shall be undertaken. In the case of a trust, the law firm shall identify the settlor, trustees, the protector, if any, and any other natural person or persons exercising effective control over the trust, and the beneficiaries or class of beneficiaries, so that the law firm is reasonably assured that it will be able to establish the identity of the beneficiary at the time of payout or when the beneficiary intends to exercise his vested rights. Other regulated agents of and service providers to the trust, including the identity of any person purporting to act as a manager, accountant, an investment advisor, or tax advisor. If a law firm forms a suspicion that a transaction relates to an identified risk, the law firm shall take into account the risk of tipping off when performing the customer due diligence measures. Where the firm reasonably believes that performing the customer due diligence measure will tip off the facility holder or potential facility holder, it may choose not to pursue those measures and shall file a suspicious transaction report. Identification and verification. Every law firm shall undertake identification and verification measures before opening an account or establishing a business relationship. Where in relation to an existing business relationship or facility, any identified risk activity under the Proceeds of Crime Act is suspected or don't exist about the veracity or adequacy of previously obtained identification information of the facility holder. Identification and verification measures should be completed before the facility holder may conduct any further business. The relevant supervisory authority may prescribe the circumstances in which verification of the identity of the facility holder and beneficial owner identity may be completed as soon as reasonably practicable after the establishment of the business relationship, providing that the law firm effectively manages the risk of activities relating to any identified risk, and the delay in verification is essential not to interrupt the normal conduct of business. Reliance on CDD by a third party. A law firm may rely on a third party to undertake CDD measures as required by Section 6.3 of the FPRA, except where the third party is suspected of breach of identified risk framework as defined, or where the relevant facility holder has committed any offense designated as an identified risk. Law firms relying on third party shall immediately obtain necessary information required under Section 6.3 of the FPRA from the third party, including the identity of each facility holder and beneficial owner. Take adequate steps to satisfy itself that the third party will, upon request, provide without delay copies of identification information and relevant documents relating to customer due diligence requirement, and is subject to AML obligations, is under supervision for compliance with the FPRA obligations, and its adequate procedures for compliance with CDD. Inability to fulfill CDD obligation. Law firms that cannot fulfill the requirements of Section 5 through 9 and 14 of the FDRA shall not open the account or establish the business relationship, not carry out the transaction, terminate the relationship, and consider filing a suspicious transaction report in accordance with the FDRA 2018. Any law firm that intentionally opens an account or establishes a business relationship, carries out the transaction, fails to terminate the business relationship, having failed to fulfill requirements of Section 5 through 9 and 14 of the FDRA, commits an offense and is liable upon summary conviction to a fine not exceeding $500,000 or to imprisonment for a term of 2 years or both in the case of a legal person, to a fine not exceeding $1 million. Ongoing due diligence. Law firms shall exercise risk-based ongoing due diligence measures through the course of each business relationship, which shall include ensuring that documents, data, information, and records collected under the CDD process are kept up to date and relevant, and undertaking regular reviews of existing records, particularly for high-risk facility holders. Scrutinizing transactions to ensure that the transactions are consistent with the law firm's knowledge of the customer, the facility holder's risk profile, and where necessary, the source of funds. Ensuring the obligations with regard to high-risk facility holders, politically exposed persons, and corresponding relationships are fulfilled at all times. Enhanced CDD measures. Law firms should apply enhanced CDD measures to a business relationship or transaction with a facility holder, beneficial owner, or financial institution from a jurisdiction assessed by the IRF's Steering Committee, and such enhanced measures shall be effective and proportionate to the risk identified. The firm shall examine, as far as possible, the background and purpose of all complex, unusual, large transactions and all unusual patterns of transactions which have no apparent economic or visible lawful purpose. Take such measures as may be prescribed from time to time to counter the risks identified with respect to facility holders, beneficial owners, or entities assessed as high risk. Risk assessment of politically exposed persons. With the PEPs, law firms shall have in place appropriate risk management systems to determine whether a facility holder or beneficial owner is a PEP, and shall, prior to establishing or continuing a business relationship with such facility holder or beneficial owner, obtain approval of senior management of your firm. Take reasonable measures to identify the source of wealth, source of funds of the facility holder. Conduct enhanced ongoing monitoring of the business relationship. Record keeping. Law firms shall maintain all books and records with respect to their facility holders and transactions, and the firms shall ensure that such records and supporting information are available on a timely basis when required to be disclosed by the law. Books and records referred to above shall include, as a minimum, records obtained through customer due diligence measures, including account files, business correspondence, and copies of all documents evidencing the identity of facility holders and beneficial owners, and the results of any analysis undertaken in accordance with the provisions of the FDRA, all of which shall be maintained for not less than 5 years after the business relationship has ended. Records of transactions, both domestic and international, that are sufficient to permit reconstruction of each individual transaction for both account holders and non-account holders, which shall be maintained for not less than 5 years from the date of transaction, and records of any findings pursuant to Section 11(1)(a) of the FDRA and related transaction information, which shall be maintained for at least 5 years from the date of transaction. How records are to be kept. Records required to be kept under Section 15 of the FDRA by law firms shall be kept in written form in the English language or in a form readily accessible and convertible in written form in the English language. Mandatory destruction of records. Law firms shall ensure that every record retained by the firm pursuant to any provisions of record-keeping procedures of the FDRA, and every copy of such records is destroyed as soon as practicable after the expiry of the period for which the firm is required by any provisions of record-keeping procedures of the FDRA to retain that record. Further requirements is under the FDRA. Oops, wrong button. Internal controls. Financial institutions should develop procedures. Law firms shall develop and implement procedures for the prevention of activities related to identified risk. The procedures referred to shall be approved by senior management and be monitored and enhanced as necessary and appropriate to the risk identified in Section 5 of the FDRA or by the IRF steering committee, proportionate to the nature and size of the financial institution business, but should be at a minimum included internal policies, procedures, and controls to fulfill the obligations pursuant to the FDRA, adequate screening procedures to ensure appropriate and high standards when hiring employees, ongoing training for all statutory directors, officers, and employees to maintain awareness of the laws and regulations relating to identified risk, to assist in recognizing transactions and actions that may be linked to identified risk, and instruct them in the procedures to be followed in such cases, and independent audit arrangement to review and verify compliance with and effectiveness of the measures taken in accordance with the FDRA. Designation of a compliance officer. Law firms shall designate a compliance officer at senior management level to be responsible for the implementation of an ongoing maintenance of the internal procedures and controls of the firm in accordance with the requirements of the FDRA. The CO shall on demand have unrestricted access to all books, records of employees of the firm as may be necessary to fulfill their responsibilities. Suspicious transactions. Notwithstanding any other law where any person conducts or seek to conduct any transaction by, through, or with a law firm, whether or not the transaction or proposed transaction involves cash, and the firm knows, suspects, or has reasonable grounds to suspect that the transaction or proposed transaction, one, involved the proceeds of crime conducted at the time by poker, is related to an offense under poker, is an attempt to avoid the enforcement of any provisions of poker, or is an identified risk. The firm shall, as practical, after forming the suspicion, report the transaction or proposed transaction to the FIU. See further requirements under the FDRA and poker in regards to reporting. For auditors to report confidentiality and tipping off. Training procedures. Pursuant to the Financial Intelligence Transaction Reporting Regulation 6, the law firm shall take appropriate measures from time to time for the purpose of making all relevant employees aware of provision of the FIUA, FDRA, FCSBA, POPA, these regulations, and any other statutory provision relating to money laundering, and of the procedures maintained by the institution in compliance with the duties imposed under these regulations. The law firm shall provide all relevant employees from time to time, in any case at least once per year, with appropriate training in the recognition and handling of transactions carried out by or on behalf of any person who is or appears to be engaged in money laundering. Training under this regulation shall, in addition, be given to all new relevant employees as soon as practicable after their employment. For the purpose of this regulation, an employee is a relevant employee if at any time in the course of his or her duties, she has or may have access to any information which may be relevant in determining whether any person is engaged in money laundering. Staff recruitment, education, training procedures, KYE procedures. The financial service industry in the Bahamas, as in any other jurisdiction, is challenged with managing a diverse range of risks, such as reputational, legal, operational, etc. Consequently, in addition to law firms implementing proper procedures to mitigate risk from external forces, attention should also be placed on risk, including those in screening, should be implemented and documented for hiring of employees. In this regard, the Commission offers some guidance to its registered law firms, which may be useful in managing the related risk. See our recent issued codes for more guidance in this area. Law firms must take appropriate measures to familiarize all the employees with policies and procedures designed to detect and prevent money laundering, including those for identification, record keeping, internal reporting, and any legal requirement in respect thereof, and training programs which incorporate the recognition and handling of suspicious transactions. Staff must be aware of their personal AML statutory obligations, including the fact that they can be personally liable for failure to report information in accordance with internal procedures. All staff should be encouraged to cooperate fully and to provide a prompt report of any suspicious transaction without fear of reprisal. It is important that all law firms covered by the Compliance Commission Codes of Practice introduce adequate measures to ensure that staff members are fully aware of their responsibilities. To strengthen the firm's position, the Commission strongly recommends that employees are requested to sign a confirmation document to indicate that they have read the Codes of Practice and any other requisite manuals that the employee is expected to be familiar with. Further guidance are listed in the Codes of Practice. Thank you very much for your attention.